fundsupermart.com.
Hi, can you briefly explain the fund's objective and investment strategy adopted to achieve it?
Sure. Our strategy is to invest in a range of both equities and bonds that deliver income to the portfolio and therefore onto our clients. We restructured the fund in June of last year. It was previously a normal balanced fund. The equity holdings had a lower income, and we decided to focus the equity holdings into income dividend yielding equities, which is what we did in June. We took Japan out of the fund and we now invest in Asia ex-Japan in high yielding assets in bonds and equities.
How did the fund perform last year and what were the main drivers and detractors of its returns?
It performed remarkably well. As I said, we restructured the fund in June. So in the second half of last year, or since that restructuring, the portfolio gained by about 18% until the end of the year, which was much better than a combination of Asian equities and Asian bonds in that time. The main reason it performed better was that our equity holdings delivered much higher returns, particularly in Thailand and Hong Kong, where our stocks did very well. And our bond holdings produced slightly better returns than the overall bond index. And at the same time, we were overweight equities. We had 65% of the fund in equities because we thought equities were much cheaper than bonds, and that continues to be the case at this moment in time.
What is your outlook for the Asia-Pacific region and how is the fund positioned currently?
We're optimistic on equities into the coming year. As I said, we think equities are in line with their 10 and 30-year average valuations, whereas other asset classes look relatively expensive. Cash has incredibly low yields, and bonds have quite low yields versus their history. Certainly very high-grade bonds, taking the US Treasury as an example. So we actually think Asian equities can deliver decent returns for investors, particularly if we see a stabilization of earnings forecasts, which have been getting cut for the last 18 months. If we can see some stability there, valuations are reasonable, you can see decent returns in equities. And generally, people are very underinvested in equities. They've been buying a lot of bonds for the last couple of years. We haven't seen much interest in equities, and that's just starting to pick up now, and we think that's an interesting opportunity. In Asian bonds, we own some higher yielding bonds. We still think you get paid a decent premium for owning high yield bonds. We don't generally own the highest grade bonds in the region that might only have yields of 2 or 3%. We take that money and we invest it into high yielding equities instead.
Based on the fund's latest fact sheet, its largest fixed income allocation was to China. What are the reasons for this particular allocation?
It's relatively simple. That's where we get paid quite good yields. The China portfolio yields just over 6%, whereas our overall portfolio yields about 5% on a yield to maturity basis. So we see higher yields there, and therefore we get a higher running yield, and we see some opportunities still for some appreciation of those holdings. So we're generally invested. We have an incredibly broad range of bond holdings. We own about 160 bonds in total. But in China, we're invested into property, industrials, a little bit of commodity type exposure. And we still think we're getting paid a reasonable yield pickup for owning companies in that space. You do need to be selective though, so obviously our credit team spend a lot of time on stock selection within that space.